The current live price for Plug Power stock stands at $1.98, reflecting a slight intraday decline of approximately 0.20% as the market digests the complex financial maneuvers the company has executed over the last few trading sessions. While the broader indices might be finding their footing, Plug Power is trading with a distinct heaviness, hovering just under the psychological $2 mark, a level that has become a battleground for bulls and bears alike. The volume today is notable, though slightly below the frenetic pace of last week, suggesting that the initial shock of the recent capital raise is settling into a more grinding assessment of value. When you look at a chart like this, the expectation from the retail crowd, perhaps those using the Robinhood app or Robinhood stock trading features, is often that a drop this steep represents an immediate discount, a falling knife worth catching because the hydrogen future feels inevitable. The narrative is always about the massive potential of green energy. However, the reality of this specific moment is far more mechanical and brutal. The stock isn't just down because of sentiment, it is down because the company has fundamentally altered its capital structure in a way that prioritizes survival over existing shareholder value. The disconnect here is between the vision of a hydrogen-powered world and the financial gravity of keeping the lights on at a cash-burning enterprise. While you might see Tesla stock or Nvidia stock command valuations based on explosive earnings growth, Plug Power is currently trading on the mechanics of dilution and debt management. This is the tension that defines the ticker right now, the dream of clean energy versus the math of convertible notes. To understand why the stock is pinned at this $1.98 level today, November 24, 2025, we have to look closely at the convertible senior notes offering that was finalized just days ago. In simple terms, Plug Power needed cash. Specifically, they raised about $431.25 million. For an individual brokerage account holder looking at this from the outside, a cash raise might sound good because it means the company isn't going bankrupt tomorrow. But for the sophisticated institutional players, perhaps those utilizing Fidelity wealth management or Interactive Brokers trading desks, this signals a specific type of arbitrage opportunity. These notes pay interest, but they can also be converted into stock later. Often, the buyers of these notes will short the common stock to hedge their position, creating a natural structural selling pressure that keeps a lid on any rallies. This is why, despite the good news of funding, the stock struggles to lift its head. It is a classic case of financial engineering dampening price discovery. Let's expand on the volume we are seeing. Trading activity has reached over 8 million shares in just the first hour of the session, which is significant. This turnover indicates a rotation of the shareholder base. We are likely seeing long-time holders, who perhaps bought via Fidelity Investments or Fidelity Mutual Funds years ago, finally capitulating while new speculative money enters, possibly through platforms like SoFi Invest or SoFi Active Investing. These new entrants are not buying the 2021 hype. They are buying a sub-$2 call option on the company's survival. It is a different thesis entirely. When you compare this to the stability of Apple stock, which is held for capital preservation and dividends, Plug Power has become a purely tactical vehicle. The volatility is high, attracting day traders on the Robinhood crypto and Robinhood fractional shares ecosystem who are used to wild swings. But it scares away the conservative money looking for Schwab intelligent portfolios to auto-balance their retirement. Now, I want you to take a moment and think about your own exposure. Comment below how many shares of Plug Power you currently hold, or if you are waiting for it to drop closer to $1.50 before starting a position. It is always fascinating to see where the psychological support lines are for actual investors versus what the Wall Street analysts project. Speaking of analysts, the divergence in opinion is stark. You have firms like H.C. Wainwright reiterating a buy rating with a target as high as $7, suggesting a potential triple from these levels. That is the expectation I mentioned earlier, the belief that once the factory in Georgia ramps up and the margins improve, the stock will re-rate significantly. But then you have the reality of the balance sheet. The company reported Q3 revenue of $177 million, which is decent, but the cost of generating that revenue remains high. They took a massive $226 million charge related to Project Quantum Leap, a restructuring effort designed to streamline operations. While write-offs are non-cash, they are admissions that previous investments didn't pay off as planned. For someone using online investment tools or investment help services, seeing such large one-time charges can be a red flag that complicates the growth story. The hydrogen sector itself is in a strange place in late 2025. We have seen 8 GW of potential pipeline opportunities for Plug Power's electrolyzers, which sounds massive. They are doing deals in Europe, Australia, and the Middle East. The industrial logic is sound. The world needs to decarbonize, and hydrogen is the only way to do that for heavy industry and shipping. However, the adoption curve has been slower than the hype curve. This is similar to what we saw with Tesla stock in the early 2010s. Great tech, difficult financial execution. But Tesla didn't have the same level of competition from giants like Linde or Air Liquide that Plug faces. When you invest online or look for investing sites, you often see Plug Power highlighted as the pure play. But being a pure play means you take all the risk of the sector's timing. If the hydrogen economy is delayed by another 2 years, Plug carries the burn rate. Diversified competitors do not. This brings us to the operational details that often get lost in the stock price noise. Plug Power's Georgia plant recently produced a record 324 metric tons of hydrogen in a single month. This is a critical validation of their technology. It proves they can produce liquid green hydrogen at scale, something skeptics doubted for years. If you're doing self-investing and doing your own due diligence, this is the metric that matters most. It separates Plug from the vaporware companies. They are making the product. The issue is the cost structure. They're selling dollars for 80 cents in some segments to gain market share, a strategy that works only if capital is cheap. In 2025, capital is not cheap. The interest rates are higher than in the easy money days of 2020, and that hurts capital-intensive businesses the most. This is why you see interactive brokers' fees and margin rates playing a role in how leverage is applied to these stocks. Holding a losing position on margin is expensive now. Let's look at the institutional landscape. We have seen significant shifts in Fidelity brokerage accounts and Fidelity IRAs regarding clean energy allocations. The institutional ownership of Plug Power remains high, around 40 or 50%, but the composition is changing. We are seeing more passive index funds like those you might find in Fidelity ETFs, holding the stock simply because it's in the index, while active managers are trimming. This passive flow provides a floor, but it doesn't provide upward momentum. For the stock to move back towards $5 or $10, you need active accumulation, the kind that comes from conviction that the cash burn is over. The recent convertible note offering pushes that break-even horizon further out, which is why the stock is lagging. Consider the user experience of a retail investor today. You might open your Fidelity mobile app or your Fidelity trading platform and see Plug Power down 60 or 70% from your cost basis if you bought a year ago. The decision to hold or fold is incredibly difficult. This is where intelligent portfolio strategies often suggest tax loss harvesting. Selling Plug to offset gains in Nvidia stock or Apple stock has been a popular trade in late 2024 and throughout 2025. This tax-motivated selling creates a seasonal headwind that might persist through December. It is a mechanical pressure that has nothing to do with hydrogen and everything to do with tax code. On the flip side, let's look at the SoFi demographic. SoFi stocks and SoFi ETFs tend to skew younger, more aggressive. The sentiment on these platforms is often more contrarian. There is a belief that the green flush is over and that buying at $1.98 is a steal. This creates a fascinating tug of war. You have the tax loss sellers on one side and the bargain hunters on the other. This dynamic explains the high volume we are seeing today. 111 million shares traded in a session is not just noise, it is a transfer of ownership from weak hands to strong or perhaps just stubborn hands. We also need to discuss the upcoming shareholder meeting in January 2026. The company is asking to double the number of authorized shares. This is a terrifying headline for current holders because it implies future dilution is not just possible, but probable. They wouldn't ask for the authorization if they didn't intend to use it eventually. If you use Robinhood cash management or maintain an interactive broker's account, you need to understand that your slice of the pie is at risk of shrinking. This is the sword of Damocles hanging over the stock price. It limits the upside because every time the stock rallies, the market fears the company will issue new shares into that strength to raise more cash. However, let's pivot to the potential catalysts. Why would anyone own this? Because if they pull it off, the upside is asymmetric. The Department of Energy loans, the tax credits for green hydrogen production, and the eventual pivot of heavy trucking to fuel cells are all massive tailwinds. If Plug Power survives this cash crunch, and the $400 million plus raise suggests